This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, great to have Isabella on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Isabella's picture saying, looking for the downloads. Now, Eric, what are your thoughts here on equities?
Patrick, I don't have any short-term view on the equity market, so I'm just going to go to the big picture, 50,000-foot view. I'm with Luke Groman from last week. I think the next few weeks are very uncertain. I could see this as the beginning of a global populist revolution where Donald Trump is successful in all of his campaigns, and that spreads across Europe. We see the Reform Party in the UK and AfD in Germany changing the direction of global politics. Or I could see this going the opposite direction where Trump gets stopped in his tracks by entrenched deep state Washington and we see nothing but gridlock. So I think we really need to see how successful Trump is in his second term in being able to do the things that he wants to do before we know which way the markets are headed here. The other thing I want to mention here at the top of the post-game segment is when Jim Bianco sounds an alarm bell, I listen. What Jim Bianco, who called the COVID pandemic and really nailed that call perfectly, is saying is, look, the Los Angeles wildfires have pretty much already hit a financial tipping point where the size of these losses, both insured and uninsured, is so big that it's going to lead to a major financial contagion. Now, that, of course, begs a whole bunch of questions as to, okay, do we get a federal bailout of the insurance system? How is this all going to be resolved? That will take weeks and months to sort out. We're working on getting Jim Bianco back on the show, so we'll line that up to get Jim in as soon as we can to talk about this. But start thinking about the possibility, and obviously our hearts go out to our listeners who are affected directly by the Los Angeles fires. But start thinking about this potentially being the source of a major financial contagion that's going to require major intervention from government. Where that takes the market and what the implications are remain to be seen. Again, we're working on getting Jim Bianco on the show in the next month or so to talk about this situation.
Well, Eric, looking on page 2, I have that chart of the S&P 500. And while it's clear that basically since Christmas and throughout the first few weeks of the year, we've been in some form of a market correction, but it hasn't yet turned into something more ominous. Overall, things like the Mag 7 stocks have held above their 50-day moving averages, and the markets have been more or less consolidating with almost all short-term sell-offs resulting in a quick snapback rally. And so we're really at a crossroad to determine whether a bigger distribution cycle is underway or whether this is just a typical market correction that results in a continuation pattern on the upside. With the market basically trading at its 50-day moving average, it is potentially as simple as simply observing whether a new bull trend resumes here with it staying above its averages and breaking out to fresh new highs. If this was to begin a deeper and more pronounced market correction, then we should see the pattern of these rallies failing. So, for instance, we had this big move on the CPI number. And so if we, for instance, fade that entire rally and find ourselves back below 5,900, that would be a clear indication that selling is still dominant and a further downside correction may get underway. That could result in testing a 5,700 or lower. But let's first see whether the bulls can make yesterday's rally stick. Now, Eric, let's move on to the U.S. dollar index. What are your thoughts here?
Well, we're consolidating here around 109 on the Dixie, but the uptrend still looks very healthy and very much in play. So I'm expecting that we'll continue to move to further short-term cycle highs. here and find out where this market can eventually top out. I'm really questioning whether we're going to go higher than that previous cycle, which was, 116 or something a year and a half ago. Let's see what happens.
Yeah, well, we printed 110 on the upside on an intraday basis, and the dollar remains very clearly bullish. What will be the pattern that I want looking for is whether or not old dips continue to be bought and whether accumulation still persists. Now, we're sort of in a no man's land in a sense that we've clearly beaten all of the 2-year highs that were all down around the 106, 107 level, and the only next major target or resistance level is all the highs up around 112 to 114, but that would entail the euro breaking below parity. And so there's a lot of interesting storylines here in the dollar. Obviously, the bull trend is still very clearly in place, and there's zero evidence new reversal or downtrend has begun. Now, Eric, I want to move on here to crude oil, where we have the chart on page 4. And after a 3-month consolidation that established a very good fair value zone, we had a decisive short squeeze get underway. When that descending trend line and the moving averages were beat, a squeeze of some sort really got underway that has now seen crude oil rip all the way from just under $70 to now over $80 on the upside. Now, such a strong, decisive breakout is certainly bullish from a technical perspective, but the bigger puzzle to solve is was this more of a liquidity short squeeze, or is there some underpinning fundamental reason while now crude oil will enter a new accumulation cycle? To me, it's all going to be about the pullback. If we see that all pullbacks are being bought and defended, and we don't see price action really get back under $75, $76, then it will be interesting to see whether that establishes a continuation pattern that could send oil back up to the highs of 2024. Now let's move on to the gold chart on page 5. What are your thoughts here?
Well, on Thursday morning, we're just trying to break above or break out to the upside from this triangle formation that's been in play for the last, several months now. Thursday's close should be a good tell. If we get a close over 27.40, then it's probably game on for this rally. Gold is strengthening with the dollar index, which is interesting. It's something we've predicted here on MacroVoices for several years, that we'd eventually see both the dollar and gold advancing at the same time. Seems to be that's what's going on here. So it's going to be very interesting to see what happens next.
Well, you're right about that triangle formation, and it's very reminiscent of the consolidation we saw in May and June in gold, which was a couple months where gold took a break from its bull advance and then broke out and re-resumed its trend. Now, have we broken the November-December highs? No, but we are above the moving averages and we're above the triangle descending line. And so we have a scenario where gold is toying with the idea of breaking out. So it'll be very interesting to see whether the bulls can build on this and get something bigger underway. Now, Eric, put a couple of charts into the chart deck on uranium. What are your thoughts?
Got a couple of really interesting charts that we put in the deck this week. The first one comes from Ocean Wall, and it was upgraded by the Financial Times. And this really, I think, says a lot. What it's showing us is that there is clearly and incontrovertibly a raging bull market on enriched uranium reactor fuel. That's EUP on the chart, up more than 506% in the last 3 years. So there's no question that this nuclear fuel bull market that I and so many other people have predicted and been talking about for the last couple of years is on. But holy cow, look at that chart. Why is it on in the enriched uranium that we can't invest and speculate directly in, but for U308, which is the raw uranium oxide that reactor fuel is made from, it's stagnating. It's just been flatlining for the last year. Look at the fact that in 2024, it's clearly been the most brisk up year in that EUP rally. And again, EUP stands for enriched uranium products. It means the low enriched uranium reactor fuel after it goes through the conversion and enrichment process. Now, there's a few mysteries about this. What is this chart really telling us? Almost everybody is saying, okay, clearly what it means is any day now, U308 just has to respond sharply to the upside to catch up with EUP. The question I'm asking is, look, this divergence has been here for more than a year. What is driving the divergence and how long can it last? And I think the answer has to do potentially with the conversion and enrichment bottlenecks that we have in the fuel cycle. Now, there's some mysteries about this. The narrative around conversion and enrichment has been that the bottleneck is more in conversion as opposed to enrichment. But look at this chart. It's very clearly saying that the price signal the market is sending us is that divergence is between EUP and UF6, which means the output from conversion and the input into the enrichment process is UF6. The output is EUP. So it's getting from UF6 to EUP where the big price divergence has occurred. That suggests that it's enrichment rather than conversion, which is sucking up all the money here. And I think it is very easy to conclude that in the intermediate to long term, U308 has to catch up to the upside. The question is, why has this divergence existed for a full year, and how long is it going to last? And is it related to a conversion and enrichment bottleneck in the fuel cycle? Is that the reason that we see the raw uranium not keeping up with the enriched product? So it's a mystery. I want to continue to try to get to the bottom of this and talk to some nuclear guests in upcoming weeks. But I think it's very important to understand that the rally is definitely on. It's confirmed in enriched uranium nuclear reactor fuel. It's the raw uranium, the stuff that we're able to speculate on, that is not responding. And the reason it's not responding is the mystery. Now, the second chart is one that I think maybe has a little bit of wishful thinking built into it. It's showing us that what's been going on is there was a fair amount of stock of U308 that the utilities owned. They were using up their own stock, using their stockpiles rather than buying replacements, hoping that the price was going to go back down. Now they're supposedly running out of it, and they're not going to have a whole bunch of on-hand stocks. They're going to have to buy replacement starting in 2025. I don't know who prepared this chart. It says the data comes from UXC, which is definitely a very reputable firm. I don't think UXC prepared this chart. My question is, how do you know with certainty exactly how much uranium they're going to keep on hand for the next 10 years? So I'm a little bit skeptical of this chart, but if it's true, we're getting to the point where those utilities have run out of their U308 stockpiles. They're going to have to start replacing it. Is that really true? We'll see, but I want to get some more uranium experts on the show and ask them about these charts and what's causing this big divergence on the first chart and how long it can last. That really is the big question in my mind.
Well, uranium has still technically been quiet, but certainly when a new buy cycle gets underway, it's going to be very interesting for the upside play of where uranium will go. Finally, though, Eric, on page 8, I just have that chart on the 10-year Treasury yields. And what we've continued to see for months now is yields increasing over 100 basis points. Now the question really is, did we see a short-term high? The CPI print created almost a 15 basis point reversal off the highs. The question was just a short-term reaction, or are we seeing that this rise in yield cycle has played out, and now we're going to start seeing a period where the yields start to stabilize up along these levels?
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.